Welcome to the Hahn 2013 Review and 2014 Outlook, an exclusive presentation for Hahn referral advisors and clients. My name is Robin Graham. I'm Vice President Business Development for Hahn Investment Stewards. I'll be your moderator today, and I want to thank you very much for taking the time to join us. Today's speakers will be Tyler Morty, President and Co-Chief Investment Officer, and Wilfred Hahn, Chairman and Co-CIO as well. Today we're going to explain the strategies at work in our portfolios over the last year and how we've positioned the portfolios for the year ahead. We will take your questions at the end. Please use the chat box facility at the bottom of your screen, and Tyler will be taking your questions. We will be recording this webcast. Thanks very much, and now I'll turn you over to Tyler.
Okay, well thanks Robin, and New Year's greetings to everybody on the call. The basic format for this call is I'm going to give a bit of an unvarnished retrospective of 2013. We've got a sort of tight-knit group here today. So we can be pretty candid in our comments, and we're going to sort of discuss some of the things we did right and some of the things that we did wrong. Then Wilf is going to talk about current market conditions and the outlook for 2014. And then I'll wrap up and discuss some specific opportunities in the period directly ahead. And as Robin mentioned, please use the chat window to enter your questions. So let's jump in right here with the 2013 review. And here we're showing the annual returns for all of our portfolios. We've got 9 core portfolios you can see on the left there, and 2 income-focused portfolios. And it shows our performance versus our composite benchmark, so what we measure ourselves against in terms of performance. And you can see the returns vary from about, for a very conservative balanced mandate, the domestic income balance right at the top there, about 2.5% all the way up to 15.4% for the global growth portfolio. And then for the income-focused portfolios, we were up actually 3.1 and 4.6. So, you know, not a disastrous year, but we're definitely cognizant that we did underperform not only our benchmarks, but, you know, what I would consider an average balanced portfolio last year. So I want to talk about why we lagged and why we think that's going to be sort of a transient thing going forward. But I will point out here before I jump into why we've underperformed is that the income-focused portfolios, which were launched in June of 2008, actually did show a reasonable return for last year. And in a year where anything that was yield-oriented got hit really, really hard, if you look at some of the funds such as the notable Bill Gross or Jeffrey Gundlach, they were all quite negative for the year in their income mandates, and we actually managed to eke out a positive gain. So that's the nature of those mandates. Those of you who are familiar with the income focus, it's taking a collection of yield-oriented assets from around the world and really trying to tactically manage the interest rate risk. And I think we did that quite successfully last year. And again, not great returns, but still they're not negative like the peer groups and that kind of thing. So let's talk about the reasons why we lagged, and this is important to to position to your clients and just to make sure that they understand what our view is. And I've always said that it's imperative that clients understand our process, because it can be contrarian at times, it can seem conservative at times, and we've been sort of accused of leaving the party early. We are party poopers at times, and we try as we may to stay as late, but we'd rather be out of the market wishing we were in than the opposite of that. So the first reason that we underperform, I think, is our continuing view on the world of central banks and how, when you have more policy-making levers being sort of triggered, you do have a potential for a wider set of scenarios. So you can't tilt your portfolios to just a growth scenario or just an inflation scenario or just a deflation scenario. You really have to build more insulated portfolios. And it's like if you have to insure your house against a variety of calamities, fire, flood, et cetera, all those things increase the premiums. So they do, sometimes they do act as drags, and you can think of that insurance scenario. So one of the things that, speaking of insurance, one of the things that really did hurt our portfolios last year, and keep in mind, we were only holding a small percentage of it, but that was gold stocks. And, it was expensive insurance last year. It's no doubt about it. Our gold holdings were responsible for about 50% of our underperformance. But I mean, I think it's important to keep that in perspective. Like gold stocks were down 50% last year. The likelihood of that performance repeating is very, very slim. Like the probability is really, really low. And we're already seeing some of that reverse in the year-to-date period here. Gold stocks are up about 15%. So violent moves like that, I mean, we had tax laws selling into the year-end, and that kind of thing did cost us. And, you know, we're not gold bugs. We're not, you know, a company that has 50% of our assets in gold, but we do like it for its insurance properties. It just happened to be one of those anomalous years where the insurance cost us a lot of our performance. And finally, one that's quite important, and I think it's important to note why we emphasize income orientation. But last year, everybody is familiar with the taper tantrum when Ben Bernanke in May of last year announced that they were going to start tapering their extraordinary asset purchase, known as QE. You know, the most hit assets were the income-oriented assets. So bond yields went from 147 on the U.S. 10-year all the way up to over 3% at one point. And think of all the collateral damage that had on the yield-oriented assets. The flip side to that is that we think that there was a lot of indiscriminate sell-offs in a wide variety of yield-oriented assets. Like, as an example, one of the unique assets that we own is mortgage REITs. And, you know, they've done an extraordinary job of managing their interest rate risk, but the market just sold off anything that was yield sensitive. So for us, that does spell opportunity. We're sort of thrilled that we can now bring portfolios that have a really, really high income component. And our portfolios have, on average, are relative to the underlying composite benchmark. The yield on our portfolios is about 40% higher than the composite benchmark, so significantly higher. And, you know, in absolute terms, in real yields, the income-focused portfolios, the fact sheets are available on our website. You know, we're almost at a 5% yield in those portfolios. It's not a bad yield anymore. So we've had some income restoration, and it's certainly a more hopeful outlook than it has been in the past, and that's something to be encouraged by. So, you know, it's become almost cliche to you know, tell clients to focus on the long term, but our style, again, which tends to be contrarian at times, it is very important to focus on the long term. And so you see the sort of our core mandates, the international income balance and growth, and then our international income focus. The since inception returns are really, really good. I mean, we've had a pretty demoralizing decade in capital markets, and to be up in the international balance portfolio 7.2% annualized since inception of June 2003 is quite remarkable. And if you compare to your peer averages, such as the ones you'd see on Globe Fund and that kind of thing, we're outperforming by a lot. So it's been a decent experience. Yes, 7.2 isn't the greatest number seen over the last 30 years, but you know, in the context of a very challenging capital market environment, it's been good. So I mean, we never want to focus too much on the short term, and still a year is a short term. But you really have to sort of shift clients' mindsets to focus on long-term returns. Let's talk about our style for a second here, because I mentioned that's the most important thing in meeting expectations and ultimately making your job easier. And I think with Hahn, there is a bit of a unique positioning in that we do tend to underperform in frothy markets. So, for example, last year, if you would have told me that there was a lot of momentum, the S&P was up 30%, you know, biotech stocks, which actually we held, were up 68%, I would have told you that we would have underperformed. I could have told you that in advance. So you have to you know, position that with clients that Hahn is, you know, leaves the party early and really protects on the downside. But also we protect on the upside as well. We do get good early upside capture. Like 2009, we outperformed our benchmark by 8 percentage points in the international balanced. So, you know, you got to keep a perspective there for clients, but it often is modulating their temperaments, because, you know, when your brother-in-law made 50% last year, we will be down less than that, and it's only when the bad times come that you'll sort of have some redemption there. So we've got a stewardship culture that's in our name. It sort of permeates everything we do. That goes from the way we look at risk to, you know, our borderline obsessive dwelling on transaction costs and not doing costs or trades if they're not material. We do avoid the big mistakes, and I'm kind of fond of talking about the business this way. It's a business of making mistakes. Like, managers who tell you that they don't make mistakes are either lying or delusional. So the only difference between the winners and the losers is that the winners make the small mistakes and the losers make the big mistakes. And we're fond of showing a graph that shows that financial planning and tax planning is actually more important than what we do, than generating returns. We love showing that graph. And that's sort of a testament to what you do and the importance of what you do. But our job is just to, that's the way every morning that I wake up, I'm thinking about how to avoid those massive mistakes in portfolios. Always remain diversified, always remain sensitive to risk, and so forth. And that's sort of the Han story in a nutshell. We tell it like it is, so we're known for being quite intellectually honest. We don't have an overzealous PR department telling us what we need to say and what we can't say. When I go on TV or Wilf's on TV or in the press, we can just actually be intellectually honest and tell it like it is. And it's sort of a joy and pleasure to work in this environment, having that independence and be able to really, really work hard for your clients and steward the capital that way. Finally, I'm gonna. Wilf's a very humble guy, but I'm gonna give him a bit of kudos here in the next few slides. But the approach of losing less in down markets has been consistent for over 3 decades, and we've got a track record that does predate June 2003. June 2003, it just happens to be the inception of all ETF portfolios for this firm. But Wilf has sort of cultivated that skill set and that approach over the years. And I just wanted to look back because it's often interesting to look back. And this is a research article he wrote right before October 1987, which everybody knows was the big financial market crash. And he was warning of a substantial market correction. September 3rd, 1987, in his weekly research note. And then you fast forward to March 16, 2000. This was an article in the Globe and Mail, and he said all the classical signs of a financial bubble are clearly evident today. And so it shows you what our style is. Yes, again, we may be early, but clients really appreciate the downside protection. And for the long-term clients that we've had, that's a lot of loyalty. When you go through a period like 2008 and you're only down 5.2% in our flagship international balance portfolio, that sleep quotient is sort of like, you can't put a price on it. It's an invaluable loyalty contributor. And sort of the payoff for that, again, is that you tend to underperform in frothy markets or late-stage bull markets. So just keeping the long-term perspective here, and that's kind of the theme of the call. We're apologetic for the underperformance in 2013, but I certainly don't think it's going to continue, and still can point to our long-term track record here. And this is just the international balance portfolio relative to the underlying benchmark, and you can see over time lower drawdowns and a lot better returns. On average, that one's been over 2% outperformance annually, which does come lumpy. Remember, 2008 we had outperformed by a lot. 2009 we also outperformed by a lot, and it's not until those inclement market periods that you really get the massive outperformance. So I'm gonna break there, and I'm gonna turn it over to Wilfred, and he can talk about the 2014 outlook, and then I'm gonna talk about some of the opportunities we've got in your portfolios after Wilfred finishes that. So over to you, Wilf.
Yep, thank you, Tyler. I want to talk a little bit about the outlook here, and first thing I want to say is that everything that we do in portfolios is based on research, method, a belief in causality, and as Tyler already mentioned, a really high sensitivity to risk. Risk is not necessarily a bad thing. One just needs to buy it at the right price. And there are periods in time where risk is very, very expensive, such as it was in 2006, 2007. And again, actually, this last little period, risk again has become very, very expensive. And markets don't always see it that way. They're not always in tune with what we're thinking, but that's a matter of timing. And I've found that if you orient yourself to those kinds of considerations, causality, trying to understand why markets are doing what they're doing and having a belief as to what they should be doing based on fundamentals is an important thing to anchor oneself to. So that's what we do. And one of the things I'd like to comment on here, we'll advance the slide here, to a description here of the commonalities of every financial bubble. It's actually quite surprising that we are experiencing the third financial bubble in the space of 15 years. It really is incredulous, but nonetheless, it is happening. We can tell it's happening, but just by virtue of research and theory. Bubbles can be wonderful on the upside. However, they do add a lot of volatility to portfolios. I think all of you, just thinking back over the last 15 years, will have bemoaned the fact that there's been some pretty big downsides, enormous downsides in that period of time. And it's very, very tough on the emotions. It's very, very tough on client relationships and so forth. And what we try to do is sort of iron that out and try to steer our way through there. And the only way we can do that is by paying very, very careful attention to risk. Now, I want to just mention quickly here, we had a presentation on this last month, but I think it's important to go over it again. And just to support why we think we're right in being careful, and we'll be proven right that we're being careful. And that is, again, we're in a bubble. And I think most like in a very late stage of the bubble. 5 indicators of a bubble. These are common to all bubbles that have occurred over the last number of hundreds of years. And looking at those, we would say we're in a period of time where risks are high, and I'll come back to that in just a second. I'll go through this list here very quickly. It's up on the screen. There's always a large expansion and debt involved with it, a huge excess in monetary supply. We're certainly seeing that. After a period of time, there becomes a very, very high reliance on capital gains. People forget about income. They don't want income. They're all about the frothy returns, or at least getting attracted to that. So that's a characteristic of that, and that's certainly an indication of that kind of condition that we're seeing now. Always a sharply higher participation level in asset markets, particularly those that can be levered. In other words, borrowed against and so forth. And we would have recognized that having happened in the housing bubble that stormed America in the 2006 period, 2007 period. So we're seeing that again. There's a lot of indicators of that. Always a misreading of underlying credit inflation trends, and that again is occurring right now. People think that price inflation is ultra low, which it is in terms of some definitions, but overall we do have inflation, financial inflation. So we really need to understand that and the impact it has on financial structures and so forth. And lastly, I want to spend just a second on this. There's always a great new world impulse that's behind some of these bubbles that makes everybody believe that they can continue forever, perhaps, are sustainable at least for a much, much longer period of time. But there's always some kind of belief behind it. It has a kernel of truth in it, and then it gets carried away. It's happened in all the bubbles. Even think back to the one that happened in Japan 20 years ago, but certainly all the ones that have happened here in North America as well. So let's look at the next slide, and we want to focus on the big new belief. And what is it today? Very clearly, it's the elevation, if you will, or the belief that central bankers today have the super prescriptions for everything and that they can fix all problems. That is a very strong belief today. And no doubt central banks do have quite a bit of power. They can really change the manifestations of how financial markets play out, but ultimately they can't create any wealth. Nonetheless, they have a very, very large influence right now, and a very large degree of faith is put in them. The fact that gold didn't do well last year is a demonstration of that alone. Anybody who would have bought gold 5 years ago, not to spend too much time on gold here, but anybody who would have bought gold or gold-related investments 5 years ago would have been 100% right in having done so based on their theories at that time, their worries of massive monetary expansion, central banks starting to create money. You couldn't have had a more perfect storm scenario that should have done well for gold, but as we all realized, gold didn't do that well, at least last year. Certainly did the years before, but not the last year. And one of the reasons why is that everybody was starting to become intimidated by the virtual powers of the central banks, and the fact that even though, and this goes back to one of the characteristics of a bubble, even though central banks were massively increasing their balance sheets and monetary reserves, it wasn't coming through in price inflation. And that, again, was very, very intimidating for the gold markets. And that just shows you the interplay of how these beliefs impact market trends and so forth. And part of that, just the last point here as to the big new beliefs, is that pretty much the entire monetary policy making environment is influenced by academics. In other words, macroeconomics, and it's passed off as a science. And everybody will probably know that macroeconomics is not a science. You can't rely on it, as you can a tool or something like that. So that's kind of what's in markets here, and that's what will set markets up for some disappointment a little later. Well, let's move on, and we'll just talk a little bit about some of our expectations and why we think we're right. In fact, as Tyler already pointed out, I think our portfolios are really ideally positioned for the likely environment that we're going to experience over the year. This high income orientation, that always adds a lot of stability to a portfolio, especially when the volatile times do come. So we feel quite positive about that. What we're showing on this slide here is a depiction of just how important that massive monetary creation that central banks have embarked upon the last couple of years, particularly the U.S. Fed. Had that not happened, had not that QE, quantitative easing, happened to the extent that it did, very reasonable presumption to have made is that you would have seen financial markets stay relatively flat. So that's a deduction. But what we're trying to show here is just how influential, over the short term at least, has been these monetary excesses. The fact is, though, and this is something everybody has to think about, what happens when these monetary excesses have to be reversed? And that's not necessarily as pretty a picture, as everybody knows, and as Tyler has already mentioned. The U.S. Fed, at least, has started to taper, and so it's a very, very different environment than the wholesale massive monetary excess that we've seen over the last couple of years. So let's move on, please, and want to make a point here, which is the Achilles heel for all bubbles. And that is, as optimism goes up, and right now we do have record optimism overall, both for expectations on stock market returns and also economic growth. And those kinds of environments breed a lot of unstable financial situations, leverage, and so forth. And we clearly have seen that happen over the last 5 years. There's a lot of speculative capital that's out there, levered, and so forth. And whether or not one believes that economies are going to slow or speed up or whatever the fundamentals may be, it's alone those speculative positions that get triggered and cause those problems that nobody really wants to see. And they're very difficult to predict when they happen. And that's why we need to be so careful about risk, because one can't forecast exactly what that catalyst will be. Think back to 1987. 1999, 2000, 2006, 2007, none of those things that triggered the final recognition of the fact that risks were high and unstable financial conditions were existent could have been predicted in specific. But what you can predict is, or at least identify, is the overall nature of the environment that we're in. And that's why we're saying we recognize that we're in a speculative period of time again, and it's a bubble. Now, next slide, I just want to, this is a very good one to demonstrate for everybody what kind of drives our thinking, and also we'll give you some evidence as to what we're talking about, what happens in the bubble environment. If you look at those items that you'll see on the left of the screen, those are all financially related sectors, categories, investments, if you will, that are part of the financial economy. We're talking here about the central bank balance sheet, stock markets, also even real estate. We have an example there of a real estate, again, getting a little frothy in some areas in the U.S. Those are all asset types that are highly stimulated by low interest rates and monetary policy. So they all inflate and can inflate quite a bit in some of these late-stage environments. But if you look at the right, the real economy issues, those things which financial markets must rest upon, depend upon longer term, those haven't come through. And that gives us plenty of reason to continue to take a steady course as opposed to getting carried away with some of the monetary frothiness. So let's look over to the next slide and we'll talk further to GDP outlook and inflation outlook. Here's something that very few people are recognizing and looking at, and that is that global price inflation trends around the world continue to decline. It's a big puzzle and for many to understand why that's happening. But here we are, despite this massive monetary infusions, we still have this underlying deflationary toe in economies around the world, whether that be Japan, Europe. Europe is a little scary at the moment. But when you get low inflation like that, and again, it's continuing to decline over the longer term with low economic growth, which is what we have, it really narrows the margin of safety. We're talking here about 3 or 4% nominal growth in the cash economies, and that's pretty tight, especially when leverage and speculative positions go up. The next chart will show just the overall trends in economic growth, and what we're showing here is an economic trend indicator for the U.S., just to give you an example. Lately, as everybody will recognize, there's been a fair bit of optimism again on economies. Economies aren't growing fast. We would have talked about 2% growth 5 years ago, nobody would have been excited, but today people are, at least lately, and if you look at that in the context of long-term trends, economies are slow, and there's no case to be made here that economies are going to accelerate rapidly. There's too many structural things at play right now. And so if you look to those kinds of things which are sustainable, real causal research-related fundamental issues, they underline why we've taken some of these cautionary approaches. And we think lately markets are coming around to seeing some of the perspectives that we are, and that will end up being proven right. We can't say exactly when, but having been through this myself I think this is the 5th major financial bubble I've been through, I can tell you when we're at stages like this, it's never pleasant. Tyler showed a picture there of a research piece when I was research director for an American firm. When we came out with that position, which was based purely on research, we were not popular. In fact, I got hauled on the carpet by the marketing department, and they said, well, we don't like your message. But as it happened 2 months later, everybody was happy that we took the approach that it was. And I can say that that's been one of the great things about this industry is that if we hold to our perspectives, clients have in the end very much appreciated the approaches that we've taken and the stewardship type of approach to their assets and haven't speculated carelessly with it. So I'm coming here to the end of my presentation, and I'm going to turn it back to Tyler. The next slide just quickly gives you a perception as to what the return environment is on a sustainable long-term basis. What we're showing you here is return expectations, and these are largely ones that we share in our own work. And so we're thinking that financial markets and our portfolios will continue to generate positive returns over the next 7-year environment. Always tough to predict a year in specific, so that's why we look at it in 7-year blocks. But overall, returns are going to be more modest. And so for our portfolios, still positive numbers. Again, as we mentioned, we've been trying to take advantage of income. World's still in an income crisis and an income slowdown, and so we think that's going to work out. And with that, I'll turn it back to Tyler, who's going to talk about some opportunities in 2014.
Okay, thank you, Wilf. And before we all reach for our antidepressants here, I'm going to insert some levity and some optimism. And but I mean, again, Wilf and the team's analysis obviously is based on research, and we certainly never like to bring forth negative things. But again, we have the luxury of having this environment where we can just call it like we see it. So that's sort of where we're at right now. So I want to talk about some of the opportunities. I hate to frame it in a calendar year because that's somewhat arbitrary. I like to look out over the next 3 to 5 years here, but there are sort of what I would consider 3 big categories that are grounds for really, really good optimism. And one of the things that we always say in our firm, one way to look at making money, so to speak, is that there's sort of 3 ways to make money. You can sort of run with the herd, and there's those momentum style trades, which sometimes we do fall into that camp with some of our analysis. There's the mean reversion trade, so something that's gone too far in one direction. There's the gravitational pull either back to the long-term averages. And the third is something called carry trade strategies, which is anything that you're sort of playing the yield curve or lending to higher credit strategies and that kind of thing. So it's more of an income orientation. And one of the things that we've been on record for the last 2 years here is citing our view on the Canadian dollar, which is, it's a very, very interesting topic right now. We could talk about it for the next 2 hours here. But, I mean, here's the view. Canadians have had this, it's been very difficult to be a global money manager. The Canadian dollar went from 62.5 all the way up to 110. And, that's big for a stock, let alone a currency. So we have to recognize that currency move is very, very anomalous, and it gives people opportunities. Like, people always line up at the border to go shopping in the States, and this has been true over the last few years. They should be doing that with their portfolios. So we think that the direction for the Canadian dollar, there is some momentum behind it, sticking with these 3 ways to make money themes. And, the funny, you might say, well, okay, the Canadian dollar historically has been pretty cyclical with the U.S. economy, and the U.S. economy is showing some signs of recovery, which it is. And here's why we think it's going to be different this time. And those are always dangerous words, but I think there's the analysis is sound. There's 2 things. Whenever you had a rebound in the U.S. economy, typically the Canadian economy was high beta, so the currency would go up and the stock market would go up by some factor of the U.S. market. The difference this time around is that if you look at those industries and sectors that contributed to that high beta rebound, it would be manufacturing and energy. And so we look at manufacturing. Manufacturing in the year 2000 was about 16% of the Canadian economy. Now it's less than 10. For example, we've had hot auto sales in the States, and we haven't been big beneficiaries of that in Canada here, whereas historically we were beneficiaries. The second one would be just the price we're getting for Canadian crude, and everybody knows about the pipeline blockages and those types of things. So the rebound in energy isn't as severe as before. So we think that's sort of a tailwind for the next little while here. And it's not just the U.S. dollar, it's a lot of other currencies. We've been on record for being bullish on the renminbi bond market. And, in our client portfolios, we do hold dim sum bonds, which are offshore Chinese renminbi-backed bonds. And that's kind of, in bond markets last year, that one was up 6% relative to negative returns for a lot of bond markets. And, that the ETF vehicle being able to go into those asset classes and to kind of insulate portfolios that way is sort of a differentiator for our portfolios. Wilf mentioned that we think that, the portfolios are going to be really resilient for the type of environment we foresee. Look into those plain vanilla portfolios, like the average 60-40 that you would see in Canada. That we don't think that's going to be good enough. We think you have to go a step further and include some of these asset classes, like the dim sum bond market, that can kind of create more diversification, different return streams, and so on and so forth. So second one would be the value we see in select emerging markets. And emerging markets were hot for many years. We all know that. And they haven't been hot in the last few years. And you look at some markets around the world, and just like it's the values, like some Eastern European countries are trading on 5 times earnings. They throw off dividend yields over 4%. Even comparing the S&P 500 as an example to the Chinese market, the S&P 500 is up about 50% over the last 3 years, and the A-share market, that's the market that's available to locals and now through ETF form, is down 50%. So we think there's going to be some mean reversion over the next few years in emerging markets. And yes, we're conservative in portfolios here, but we also hedge that conservatism by including some of these assets that could be really, really good performance. But the values there are just incredible. And you look at the fundamentals and the soundness of emerging markets, and it's not going to be a replay of the late 1990s Asian crisis, maybe in some pockets, but in general they're just they're more well suited towards the new globalization, and importantly, they've got more room for policy room maneuver, right? Like the central banks in the West all had the monetary pedal to the metal last few years, and interest rates pinned at lows and so forth, and that's just not happening in emerging markets. So they've got room to stimulate. And then finally, there's the just all these yield-oriented assets. I've mentioned mortgage REITs, but we've got a whole slew of other yield-oriented assets in our opportunity asset class. And the joyous thing you can bring to clients right now is we have real yields that are actually high again, or respectable, let's say. And so that's sort of where we see the opportunities, and it certainly does paint a case for some optimism over the next few years here. And we're not changing our investment style. That's something. Like, we don't have a bad year and say, well, it didn't work last year, so we definitely have a longer term view than that, and it's important that our clients understand that process, as I mentioned. So, again, it's important to keep the long-term perspective here. Last year was only the second time in 11 years that we underperformed. yet still you see the returns there, and they're much better than the composite portfolio and much better than the average portfolio. So I'm going to wrap up there, and we're going to look at the questions in the queue. I know we've got a number here, so we'll try and get in as many as we can. We've got about 10 minutes here, and I'm going to try and answer some, and as is Wilf. So we're just going to pull up the chat bar here and see what the questions are. Okay, so we've got one question on Japan. What's your view on Japan? That's actually funny. Someone asked that because I've got an article on indexuniverse.com today. It's called "Is the Easy Japan Trade Over?" And you know, for us, I mean, it's another case of a large degree of faith in what policymakers are doing. So many people would have heard of Abenomics, the new prime minister there, Shinzo Abe, has a new plan to get Japan out of their 25-year deflationary funk. And he's got something called the three-arrow approach. And the three arrows, the first one is monetary stimulus, the second one is fiscal stimulus, and the third one is structural reform. And you know, I'd encourage you to read my article because I go into more depth there. But the first two arrows have been fired as of last year, and that was radically promoting QE, trying to get inflation up, and that's sort of the monetary and fiscal stimulus. And it did create an epic rally in the Nikkei, the local Japanese market there. It was up 47% last year in US dollar terms. So, you know, they're kind of at the stage where the rest of the West is at right now, and they're at the stage where, you know, we're saying, okay, we get it, monetary and QE and all these types of machinations can lift stock markets. But the next phase is structural reform, which is, you know, changing the corporate tax code, introducing new taxes, you know, some of the tougher stuff. And I think Japan's still in the same situation a lot of these Western markets are, in that, you know, you need to see some follow through. And I think that if you can bring the broad narrative right around to today's context, it's interesting because, you know, again, a lot of these countries are in the same situation. Last year, at the beginning of 2013, we had a lot of worries. If you take your mind back there, we had the fiscal cliff worry. We had the European crisis still going on. We had the supposed collapse in China. And this year, you know, we're sitting in our seats in January 2014 here, and it's apparently smooth sailing. There's no big macro risks out there according to the consensus, and that always worries us because we've been in this business long enough to know that markets price themselves off expectations. So if there's expectations last year that there's going to be these big rupturous macro events, then obviously asset prices are going to be lower. Conversely, this year, when there's sort of a more ebullient note on economics and financial markets, then markets have already priced that in. So that's sort of the broad narrative that we're working on right now. It doesn't mean that there's going to be another financial crisis. It just means that the conditions are present to not have a so good next couple quarters, and that's what we're sort of attuned to right now. Okay, we've got one more question, and you know, maybe Will, if you want to handle that one. It's a question on the U.S. fiscal situation. It's asking, is the U.S. fiscal situation healing? Because you know, the last few years everybody's been sort of down on the U.S. and now it seems to be the darling country. So maybe you can attend to that, Will.
Yeah, that definitely has changed. Everybody remembers back when the global financial crisis ensued. America was seen as the bad actor on the world stage. America took quite a bit of criticisms from a lot of other countries, and here we are at this point in time, and that's already been the case for at least a year, actually a couple of years. American stock markets have been amongst the best performing in the world, and continues, in fact, even to be seen as a safe haven. Speaking directly to the fiscal question, the federal budget deficit has continued to decline, so from that sense, yes, it has been healing somewhat. You'll recall at one point the U.S. budget deficit was as much as 10% of GDP, an unprecedented number, at least since the Second World War days. So we're down to 4%, and in that sense, it's quite an improvement. 4%, however, is still extremely high, and so you know, we would want to see that continue to decline in future. But But seeing, and you always have to measure these things globally, America has quite a ways to go to catch up with some of the fiscal fixes that have taken place in some other countries. For example, there are some European countries that have got their deficits down quite a bit, such as Germany and so forth. So, as I say, America still has a way to go.
Okay, thanks, Wolf. We've got another one here, which is quite predictable, and that is what is our view on gold and gold stocks. So I can take that one. So, again, we've got a little bit of egg on our face because we've continued to hold gold stocks only in the proportion of 5% portfolios last year. And I mentioned that the XGD, the ETF that we hold, is down 47% in 2013. So here's what we did. We had our December strategy meeting, and this is our view. We looked at gold, and we've got a number of risk factors that we go through to determine if the asset is worth holding the portfolio. And one of the things that we are big on, as most would know, is we're big on the behavioral psychology portion of things. And we have sentiment indicators. It's sort of a voyeuristic look into what people think about different asset classes. And the sentiment was actually, for the first time in history, it said that near 100% of the respondents did not like gold or gold stocks. And, those aren't always good contrarian indicators, but at that time we felt, okay, gold stocks and gold is going to have a bit of a bounce here, at the least over the next couple of quarters. And so that's kind of where we're at with gold equities. We actually increased the weighting. We held 3.75. We had lowered it in September and raised it back to 5% in December. And kind of you may have heard the line, there's no bad assets, there's only bad prices. And we feel that a lot of the bad news, so to speak, was discounted in the price of XGD. And, we're seeing some really, really encouraging signs in the year-to-date period here. Even you can see some of the speculative, or not speculative, but the M&A activity in the gold sector is starting to flare up and everything like that, which typically portends that there may be some action in those markets, and it could go up. So we still like gold stocks for their their non-correlated properties, for their insurance purposes. But we also think there's a good value story there as well, based on beat up sentiment and having a really, really cheap price. I'm going to wrap up there because we've got a number of other questions here, but we've only got to a quarter after. So I just wanted to thank everybody for their support. We're always available to answer questions and